Have you ever looked at your life insurance policy and felt like you were trying to read a foreign language? Yeah, you are not alone. So today, we're going to be your guide. We're going to decode all that fine print and turn that complicated contract into a simple user manual so you know exactly what you're dealing with.
So, what's actually hiding in the pages of your policy? Well, you might be surprised to find out that New York law actually builds in a whole bunch of consumer protections right into your contract. They're designed to protect you from the moment you sign up to years down the road.
Here's how we're going to do this. We're going on a journey through the entire life of a policy. We'll start with the absolute basics, then walk through those critical first 30 days. We'll cover how to keep your policy going, explore the key protections and pitfalls, touch on some advanced options, and even look at what happens if you decide you want to sell it.
Okay, first things first, let's lay the groundwork. What actually makes up your policy? It sounds like a simple question, but the law is super specific about this. It's something called the entire contract provision.
Now, this provision is simple, but it is incredibly powerful. What it means is that any verbal promises some agent might have made to you, they don't count unless they're also in the written policy or in your original application. The big takeaway here is, if it ain't in writing, it's not part of the deal. This protects everybody from any he said, she said confusion later on.
So, you've signed all the papers. The policy is officially in your hands. But what if you get that feeling of buyer's remorse? This brings us to what you can think of as the policy's honeymoon period.
This is one of your most powerful rights right at the beginning, the right to examine. Honestly, just think of it like a 30-day, no-questions-asked return policy for your life insurance. It gives you this pressure-free window to actually sit down, read everything, and make sure it's really what you wanted. And if it's not, you can send it back for a full refund.
So, how long do you get? In New York, the law says this period has to be at least 10 days, but it can be as long as 30. Your specific policy will spell out the exact number of days you have, so make sure you check that as soon as you get it. Maybe even mark it on your calendar.
All right, so you've passed the free look period, and you've decided to keep the policy. Great. Now, how do you keep it going for the long haul? Especially if, life happens and you accidentally miss a payment. This is where grace periods and reinstatement become your best friends. A grace period is basically your built-in safety net. Let's say your payment's due on the first of the month, but you completely forget. The grace period makes sure your coverage doesn't just disappear overnight. And get this, if the insured person were to pass away during that grace period, the death benefit still gets paid. They just subtract the premium that you owed. It's a really critical protection. And in New York, that safety net is a full 31 days, or 1 month. This isn't just a nice little courtesy from the insurance company either. It's the law. That is a key piece of info to have in your back pocket.
But what if you miss the grace period and the policy actually lapses? Well, all is not lost. You generally have up to 3 years to bring it back from the dead, so to speak. You'll have to reapply, prove you're still insurable, and of course, catch up on all the payments you missed plus some interest. But it's often a much better choice than starting over from scratch.
Okay, this next section is huge. These are the rules that protect you years, even decades after you've bought the policy. This is where you see the real power of consumer protection law in action.
The incontestability clause is absolutely fundamental. It basically means that after a certain amount of time, the insurance company can't just cancel your policy because of a mistake or a misstatement on your original application. The only exception is if it was outright fraud. This is so important because it prevents them from trying to find some tiny loophole to deny a claim many, many years later.
And that critical window? It's 2 years. Once your policy has been active for 2 years, it becomes incontestable. For any policyholder, hitting that 2-year mark is a major milestone that gives you some serious peace of mind.
So what about an honest mistake? Like what if you got your age wrong on the application? Does that mean the policy is void? Absolutely not. The law is very clear on this. The benefit just gets adjusted. The insurer simply calculates what the premium you were paying would have bought at the correct age, and that becomes the new death benefit. It's a fair, common-sense solution.
It's also really important to know what isn't covered. Policies almost always have a few specific exclusions. For example, they might not pay out for a death during certain high-risk aviation activities or from suicide within the first 2 years. But even in those cases, it's not a total loss. The insurer is usually required to return all the premiums that you've paid in.
All right, let's shift gears a little and talk about some of the more advanced features that can be built into these policies. These are things that can help you access funds early or even grow your cash value.
Okay, so if your policy has a cash value component, you often have a choice. You can keep it in the general account, which is the safe, steady, guaranteed option. The insurer takes on all the investment risk. Or you can put it in a separate account where you get to invest it in things like stocks. With that option, you take on the risk, but you also get the potential for much higher returns. It's that classic risk versus reward trade-off.
Now, listen closely to this one. This is a direct, serious warning required by law. Some policies let you access a chunk of your death benefit early if you're diagnosed with a terminal illness, and that can be a financial lifeline. But you have to understand the consequences. Taking that money could affect your eligibility for programs like Medicaid, and it might even be considered taxable income.
And for our final section, we're going to explore an option that, honestly, many people don't even know exists. You can actually sell your life insurance policy. This is something called a life settlement.
So what in the world is a life settlement? Well, if you just cancel your policy, the insurer might give you a small amount of money back. That's the surrender value. With a life settlement, you sell your policy to a different company. They pay you a lump sum of cash that's more than the surrender value, but less than the final death benefit. Then that company takes over making your premium payments, and they're the ones who collect the benefit down the line.
So why on earth would someone do this? Well, there are a ton of really practical reasons. Maybe the premiums just got too expensive to keep up with. Or maybe your kids are grown and you don't need the coverage for them anymore. Sometimes a person's entire financial situation changes. It can be a smart way to get real value from an asset you are about to let go of for next to nothing.
And that brings us to our final thought for today. A life insurance policy isn't just some static document you file away and forget about. It's a dynamic financial asset. It's packed with legal protections and flexible options. And knowing what's in that fine print is what empowers you to decide if it's an asset you want to use, keep, or maybe even sell. Thanks for joining me for this breakdown.